mortgage update with rising interest rates. How are we doing? So in recent times we've had rising interest rates. So how are we doing? Is the market going to shit? Are we facing a housing market crash in 2022 or 2023? I don't know. Or can we thrive in this market? Let's find out. Hi, my name's Alex Kerr from Mortgage Chain Limited. We're a regulated mortgage brokerage and I've been doing mortgages since 2003. If you're interested in mortgages, please subscribe to this channel. We will not let you down. Let's get into the vid. So why do interest rates rise? The Bank of England set interest rates. They meet on a monthly basis and decide whether to put interest rates up, down, or keep them the same. The things that influence that decision includes inflation. Things that cause inflation to rise include events such as conflicts, pandemics, and import and export problems. In recent years, the economy has had to put up with problems in all of these areas within a short space of time, so it's inevitable that this is going to have a knock-on effect. The Bank of England therefore start increasing rates in order to try and bring down inflation. So we are currently getting squeezed in every direction. However, if inflation can come down, then that will have a positive effect on the cost of living, as if interest rates are increased, the idea is that it will bring prices down in other areas as there's less disposable income available. Up until recently, rates have been historically low. Why is that? Well, that was a result of the recession in 2008. Rates were reduced to almost 0% to try and encourage people to start spending again. Having rates this low means that at some point in the future, there's only one way they can go, which is up. The housing and mortgage market is never perfect. It's always in a state where it's trying to fix some type of problem from the past, and fixing one problem may solve that problem now, but normally creates a new one for the future. And so the market carries on in this way. A mortgage is usually over 25 to 40 years. You will see new mortgages taken out are usually somewhere in between these mortgage terms. Now, if you go back to 2008, the last recession, until this point now, that's only on average half of the life of a mortgage. So much has changed within this period. So over the full term of a complete mortgage, 25 to 40 years, you're going to see low interest rates, high interest rates, a recession, a crash in the market. The key is knowing what to do at each specific event. Normally what happens is when interest rates are suddenly increased, this means to the mortgage lenders it costs more to purchase mortgage funds from the money markets. You may also hear the terminology of swap rates. This is effectively mortgage lenders dealing with the money markets. Now what happens is mortgage lenders will of course increase their rates because it's more expensive to buy them, but they will also add a buffer on top of this in case rates rise again. Then when the market settles a little bit, there should be some scope to reduce rates a little bit. This is what I've seen recently. Rates have come down a little bit because things are a bit more settled in an unsettled market. So what does that tell us? It tells us that if all of a sudden interest rates go up, there's every chance that they'll drop down a little bit once the market has settled. So it might be an idea just to wait a little bit to see if that drop occurs. But it's not guaranteed. It's just based on experience from the past. There's always the first time this pattern might not happen. So what should you do? Should you buy property now? Should you wait a few months, maybe even a few years? Will property prices come down? Will the market crash? These are all questions you probably have going around your mind now. So I'm specifically talking to you as either a first-time buyer or homeowner and you want to buy a property and move home. I'm not talking to you if you are a property investor, as that's a completely different strategy. As someone wanting to either get onto the market or move home, I'm never a fan of waiting in hope that the market will crash or prices will come down. However, if rates start going up to this high level we are at the moment compared to what it was before, historically low, the likely effect it will have on the housing market is that you should be able to get money off the asking price, and hopefully we are headed more towards a buyer's market. We've been in a seller's market for some time as rates were historically low and there were so many buyers in relation to sellers that sellers could pick and choose what buyer they wanted, and a buyer would have to put in the asking price or above to purchase it because there was so much competition. But now rates have increased. If a buyer wants to sell their property, they are going to have to reduce the price as buyers can't borrow as much money or borrow the same amount as it's now much more expensive. So my approach is always the same to any market. How much can you borrow? What's your property budget? Is it affordable? Can you make it work? If you can make it work and buy a property which works for you, then take it. I see too many times people waiting around for conditions to improve when they could have made it work in the current climate. They just wanted that little bit more, which is human nature. But my experience with mortgages in the housing market is that this can come back to bite you, as things can all of a sudden get even worse or be completely taken away. And it could be another 10 years before you even have the opportunity to buy a property. What if, as of tomorrow, all mortgages needed a 40% deposit for the next 10 years? Would you be biting yourself if you didn't move now while we have access to 95% mortgages? Yes, rates are higher, but you can probably get 10, 20, 30 grand off the property price, and this will offset the higher rate. The last thing I wanted to touch on is mortgage products. There's a lot of questions around this area, and unfortunately I can't provide advice that will be correct for every single one of you watching this video, because everyone's set of circumstances are individual. And that's why we have mortgage advisors, is to advise the correct mortgage product for your situation. But the question I'm getting asked a lot is, shall I go through variable mortgages as the rates are lower than fixed rates? So like I said, I can't answer that question, but I can provide information about the specific products. When you choose a mortgage product, you basically have two choices. Choice 1 is a fixed rate and choice 2 is a variable rate. There are lots of different variable rates which I won't go into a full-blown tutorial about them, but the most common ones are discounts and trackers. A tracker is linked to the Bank of England base rate, so if the Bank of England base rate goes up 1%, so does your rate. If it goes down 0.5%, so does your rate. A discounted rate is linked to the lender's standard variable rate, where it provides you a discount on the lender's standard variable rate of interest. So if the lender's standard variable rate goes up or down, so too does your rate. A fixed rate is where your rate stays exactly the same for a period of time that you have chosen, typically 2, 3, 5, 10 years, or sometimes all the way to the full term of the mortgage. It gives the security that your monthly payment won't change. Any form of variable rate is more of a gamble because, as the name suggests, it's variable. It could change and you have no control over that. So why would someone choose one or the other? Fixed rates are sometimes chosen if you know what your plans are long term and you have no desire to pay off large chunks of your mortgage or move within a very short space of time. Typically, you can overpay in a fixed rate up to 10% of the balance per year without penalty, but paying off more than this or redeeming, which means paying the mortgage off in full, within the fixed rate term will lead to penalties. A lot of mortgage lenders do now offer what's known as a portable mortgage, which means you can take your mortgage with you within the fixed rate term without a penalty. So you are not completely restricted to moving within a fixed rate term as long as you choose a portable mortgage. You are restricted where if you want to borrow more than what your current mortgage balance is, to say move to a bigger house, you must use the mortgage lender you are currently with, that you are porting the mortgage with, to borrow the extra funds, and they may not at that point have the best rates on the market. Variable rates can sometimes be more flexible with overpayments, and sometimes variable mortgages have no tie-ins at all, which means if you paid the mortgage off in full or remortgaged to another mortgage lender, there would be no penalties at all. So if you are buying a property which was run down and your plan was to do the property up within 6 months and sell the property within 6 months, then moving to another one and use the profit you've made to buy a bigger house, a variable rate might be considered because it's got no tie-ins, and a fixed rate has a penalty. It therefore may be more expensive in that situation. As always, any type of mortgage is a gamble, and the term of the mortgage can be up to 40 years, which is a long time, and you're going to experience lots of different landscapes. So if you can survive in the worst times, then look at when rates are lower as a bonus. Now, advice I can give to anyone is that if rates are historically low, my advice is not to max out your borrowing. Because if you are in a rate of 2% and then all of a sudden when you need to renew your mortgage product, when your product expires and the best deal is 6%, your monthly payment would then triple. So it's always good to leave a buffer. Longer term fixed rates have just started recently coming into the mortgage market. I know they are very popular in other countries and have been there for some time. I do think that's a good idea to bring them in, and I do think that this area over the next few years will evolve and grow. Currently, we have variable rates which are quite lower than fixed rates, so it might be tempting to go for a variable rate. But in times like now, I would always make that decision alongside a qualified mortgage advisor. If you do want to chat about your mortgage circumstances and you have at least a 5% deposit, then please book a free chat using the link in the corner of the screen or in the description below. Minor adverse credit might be okay with a 5% deposit, but if you've got more than 1 or 2 missed payments, defaults or CCJs, you are likely going to need a bigger deposit, and at the time of this video, adverse credit mortgages typically require a 15% deposit. So if you have adverse credit and you want to chat about that, just get in touch using the link in the corner of the screen now or in the description below. Whatever your situation, the first step is always to check your credit file to ensure your voters' roll records are showing, all of your commitments are showing, and that you have no adverse credit you were not expecting. Use checkmyfile. They are, in my opinion, the very best credit agency out there, as they provide Experian, Equifax and Transunion credit reports all on one file, and these are the agencies that mortgage lenders look at to assess your data when making decisions for your agreement in principle. You can download your file for free as long as you cancel within 30 days, and it's £14.99 thereafter. The link is in the corner of the screen or the description below. If you're not after mortgage advice, we do now have a mentorship program for first-time buyers, which will help you with all the documentation you need, provide you access to mortgage affordability tools and the best mortgage rates tools, as well as walking you through the whole process, advising of the best property portals to use, how to make offers, the solicitor process, as well as providing a members-only Facebook group where you can ask any questions throughout your home buying journey. The best bit is that you have lifetime access. For more information, click the link in the corner of the screen or visit the link in the description below called Mentorship Program First Time Buyer Expert. I hope this has helped straighten a few things in your mind. If you have any questions, please do let me know. Please do subscribe if not already, as I'm looking forward to providing more videos that will benefit you and I don't want you to miss them. Any questions, let me know. Mortgage warning. As a mortgage is secured against your home, it could be repossessed if you do not keep up the mortgage repayments. So that's all from me, guys. Please, if you want to subscribe to the channel, click there. And if you want to watch a video about your credit file and how you can read your credit file through checkmyfile, watch this video here. And if you want a complete guide to buying your first home, watch this video here. You take care.